Hello and welcome to the Wealthologist Live. This is Chris Hobart and Jacob Woodrum. Happy to have you here and joining us for today's event. This is the last day of April.
It is.
So we are ready and raring to go. So if you've been with us before, we're happy to have you back. Always nice to have you participate with us. And today we're going to be digging into a number of good things. Jacob, you know, though, I always like to tell my Chris story, right?
Yeah, I enjoy the Chris story.
This is a happy, sad Chris story. You and I were talking about this. Some of you might know that I recently built a pond in my backyard. And the pond, I love it. It's great. I've had a pond before. And my passion, whether you know it or not, I love koi fish. I like to go fishing, but I just like to have koi fish, right? Well, we got everything going. I bought koi fish. Everything was good, but not everything was good. It turns out that Chris is not necessarily the fish whisperer. So we lost some fish, but the big fish and the important fish are still there. Anyhow, all that to say, any of you out there that might be koi aficionados or koi knowledgeable, I'm always willing to take your good advice. So there you go. That's the Chris story. And if you want to see pictures of my fish, I have a feeling I'm going to sneak some of those into our upcoming newsletter. So keep your eyes open. All right, well, let's get started. As we'd mentioned, I'm Chris Hobart, the Wealthologist, and with me is Jacob Woodrum, our lead investment strategist here at Hobart Wealth. So for those of you who are with us at events in the first quarter, we know that the markets, Jacob, had a pretty strong start to the year, but April April's been a little bit different, and a lot of it's because obviously what's been going on in the Middle East. Plenty of things going on there, and as we know, Israel and Iran, they've been going toe to toe. We've also got some stuff going on in Ukraine, Russia. I mean, just a lot of stuff. Yeah. But all of the fallout going on right now is really increasing that volatility. Now, I hate to say it, but we've been telling people to watch out for volatility for a while. Yeah. But Jacob, tell me, from your perspective, what's the impact on the markets? Is this going to get more broad? And I think really importantly, how is this impacting our clients?
Yeah, no, it's a great question, Chris. I mean, I think, ultimately what I want to first talk about and address is really how does this impact, the markets? And I think that's probably what is on all of our minds at this point is how does that, what does that do and how does that impact? The first thing that I wanted to mention is, in our opinion, we do feel that it's a bit premature at this point to underweight equity exposure. So we've made some changes to help provide kind of what I consider a ballast to our portfolios.
All right.
And
slow down.
Here comes.
You're talking too much. Underweight our equity exposure.
Yeah.
So what are we talking about?
Yeah, so think of underweighting equity exposure just meaning we're going to sell some of our stocks. We're going to, let's say we've got
less stock, more fixed investments.
There you go.
Okay.
There you go. Yeah. And so I think, we certainly aren't to the point where we want to say, let's sell some of that exposure. But from a geopolitical risk standpoint, there are some things happening. And, we don't feel that at this point, major escalation between us, the U.S. and China, would be something to say, okay, it's time to make an adjustment. But that's highly unlikely at the moment, not something that we're expecting. So first, let's talk a little bit just about the Israel and Iran issues that are happening. And there is a 100% likelihood that we're probably going to see and expect Israel to respond to what's been happening with, from what Iran did. And, that's an attack that really wasn't a direct attack to Israel. It hasn't happened for a long time. And it kind of seems like we've reached another level of escalation. We're going to look at a slide here in just a second that we want to focus on. And, I think this slide does a really good job of breaking down, from a longer period of time, what's the market looking like. And there we go. Yep, that's perfect. So what we're really looking at with this slide is, again, from a longer time period, what is it? What are we looking at, and how do these geopolitical issues? What are their impact on the market over a longer period of time? And what I think is important to look at is, the reality is we know that things are going to happen from a war standpoint, from a geopolitical standpoint. And this chart, I think, does a great job of showing all of those points in time since 1928 up until the present. But I think it just helps us, at least it helps me from a strategist standpoint, to say, okay, let's make sure we have a longer term time frame. Now, granted, a longer term time frame looks different for everyone, and it's not it's certainly we have to adjust markets and strategies based on time frame. But I think that's a really good slide that just shows, okay, based on what we're looking at and what's occurred and what has occurred in the past, here's over a longer period of time what the markets have done.
Jacob, when I look at that, it's crazy because it's almost like just a memory of childhood, right? Or I remember a lot of these things going on. I see the Gulf War, I see the Afghanistan War, the Iraq War. I mean, there's a lot of defining moments that we have there. It's interesting to me because obviously a lot of crazy stuff, and as we hear, time heals all wounds.
Right.
And a lot of those things they felt big and important at the time. They were big and important at the time. But as time goes on, you can see the impact was just not as significant, justified the fear at the time. But long term, the market recovered well.
Yes, well, and I think that's a good point to remember too. And ultimately, with this Israel and Iran conflict right now, we don't expect others to get involved. It's not something that others do not want to get involved ultimately. And I think most of all the U.S. not wanting to get involved. But I think it's going to depend on the Israelis' retaliation and what that does, really to Iran's response in how that kind of pans out.
So I guess from your perspective, what do we think the probability of a situation escalating even higher and having that greater impact that we really need to worry more about?
And that's really the good question there, because if it were to escalate, what does that do, and how do we manage accordingly within our models and our portfolios? But we've researched this, and we subscribe to a lot of folks who are quite a bit smarter than us in this realm. And I think right now it's about a 50% probability for Iran to respond again. But again, Iran, they're going to keep this, or want to keep this, focused on Israel. Does that bring us, the U.S., in from an escalation standpoint? At this point, I really don't think so.
It's so interesting to me too, because obviously there was talk that there was discussion in the back channels that Iran basically had said, "Hey, we're going to do this attack." They were
Right.
making the U.S. and Israel aware.
Yep.
Boy, just so much it seems like in the Middle East, it's kind of this bravado. We've got to show a power move, and then we've got to respond, and you hope that it just kind of peters out and it's calm.
Right.
There's the other side of that where it just begins to escalate, and I think that's the scary point. I would love to say I'm a geopolitical scholar in that regard, but I think the important thing is we're going to wait to see what happens, and then we're going to react accordingly. Now, obviously, these are not the only countries that are affecting the markets.
Right.
What are the other ones that we're watching right now that are posing the biggest international risks?
Yeah, we could discuss this. Chris and I could be here in front of you guys all day today talking about this. But obviously the Israel-Hamas war and Ukraine-Russia is front and center right now. But I did want to touch just a bit on the U.S.-China, geopolitical tension, specifically in the Philippines and in Taiwan, because what we've learned and from what we've heard and listened to folks, that the Chinese, they're really careful not to use or to use, I should say, Coast Guard and fishing militias. They're not using military is essentially what they're doing. And they call that gray zone activity, but they're trying to essentially push Chinese ownership of the South China Seas, which gives them leverage ultimately. I think from a U.S. perspective, from what we read and what we hear, we do need to get involved, but, and this is important, it would need to be below the threshold of military. But it's a complex framework.
It is. It's not to go political, but I was listening to a podcast, and it was Kennedy, third party Kennedy running, and he was talking a lot about this. And I'll be honest with you, I haven't really paid much attention, but a point that he made that I thought was really interesting is that, China is desperately dependent on Walmart as well as Mideast oil. And he said if we actually control one Walmart, which we do, well, I don't know if we control it, but again,
housed in the U.S.
Yeah.
Right.
But again, the more that we can control flow of oil into China, those two things alone right there could cripple China very, very quickly. So I do think that that sea is going to be an important play.
Yeah, I agree. I think we've got a second slide too that I think is really impactful as well. And there we go. So what I really like about this slide, this is really helping us view and see, okay, what's the stock market returns look like after we've had major geopolitical shocks. Now, you can see we're looking at this, from the 1940s up until the present time. And what I find so interesting and I think helpful when we look at this data is, we can see, okay, when I'm looking at the bottom slide here, the Pearl Harbor attack in 1941, what was the one-day return of the S&P? Well, we can see it was down 4%. If we then move to the right-hand side here, the next column, we can see, okay, one-year return, the 1 year full return was actually positive. It was, just shy of 4%. Now, again, we can see max drawdown. There was a big drawdown in the market of 20% during that period of time. But, if you look, even with these max drawdowns of when we've had these various geopolitical shocks occurring, we're still seeing, for the most part, pretty positive 1 year returns during that time. And so, I think it's really helpful to talk about these things and, what could happen, what couldn't happen. But when we look at the data, and look at past performance of how markets have, how they've done, how they've interacted, I think that's really important. I think it really provides some perspective and clarity when we're talking about this type of stuff.
What's interesting is the only one of these that had a 1 year negative return was the 9/11 attacks. I just find that interesting to kind of take a look at, because the 1 year return for everything else was positive. Oh, actually,
well, we had the one. Yeah, I was going to say the one, which that was 2022, and so we know what 2022 entailed, which was also the Fed, in a tightening cycle.
Yeah, and I don't know if you can blame the Russia invades Ukraine for really what we're seeing there. But all that to say that is an interesting side. So I think the question that I've got, and I think our clients also have as well, is all of this stuff going on, what does it really mean for our positions and our portfolios, and how are we making adjustments accordingly?
Yeah, and that's really a big part of what we wanted to talk about today, and specifically, what I wanted to highlight are two specific allocations that are important, in light of what we're talking about from a geopolitical standpoint. And so one of those we're going to touch on a little bit today, and the time that we have left is the buffered equity allocation that we utilize in some of our moderate portfolios and more conservative portfolios. And then also, we've talked about this before, but I think it's worth mentioning again, is the exposure that we have, that we've added to what we consider to be quality stocks, quality companies, or you could consider them, value focused. And again, it's important because, or the specific piece on quality is important because of the allocation within that to aerospace and defense spending exposure that we have in that allocation. So we'll touch on that in just a sec. But let's first talk a little bit about the buffered equity allocation. Really what we're doing with that is, we're tracking the S&P 500. So we're tracking the stock market, but it's designed to help really prevent losses or reduce volatility while we're invested. And so, we're giving a chance to grow the money still when the market gains, but try to limit volatility or limit downside.
And to be clear, this is a fully liquid investment. We're not talking about things like annuities or anything like that. This is a liquid investment that goes within your portfolio that basically has buffered protection.
Yeah, it's a very unique I think, way to invest a certain portion of funds. And we can go way down a rabbit hole and go into the weeds as to how these are structured. We're going to keep it high level today, but I think it's a great reminder if anyone has specific questions as to the inner workings, we can talk about that. But the way that I like to think about this buffered equity allocation, it's kind of like if we were to plan a picnic. So if we're imagining ourselves going on a picnic, but we're worried it might rain, so let's we decide to bring we'll call it a special umbrella, and that special umbrella is designed to protect our picnic basket, right, from getting wet. So again, the umbrella is like the buffered equity allocation. It's designed really to to shield our investments from losses, just like the umbrella. It's going to protect our picnic if it does rain. Now, there's always two sides of the coin.
Yeah, what's the trade-off, right?
Right. So the trade-off is that while the allocation, buffered equity, is going to help protect us from losses, it might also limit how much our investments grow when the sun's shining. So, and if the market's doing really well. So it's kind of like having an umbrella that's great for rainy days, but it may not let as much sunlight through when the weather is perfect. And I think that's important to mention. Again, this is why we're not going to over allocate to something like this. I think it's best used in moderation. It also depends on where we're at in the market too.
There's the old saying that there's three things that investments can do. They can grow, they can be safe, or they can be liquid.
Right.
But you can only choose two.
There you go.
What's nice about these is you do have growth potential capped on some level.
Right.
You do have liquidity, and you do have, I want to be careful about the word safety because we're not talking like a CD or anything like that, but there's a level of downside protection. So this is one of those few areas where you actually have all three of those, but the key is you can have all three within limitations.
There you go. Well, and just to give it a real world perspective on it, the S&P 500 by itself, it's up, I checked it this morning, it's up around just shy of 7% on the year, so 6.5%. And our buffered equity allocation is up almost 5%, right? So we're not completely participating all the way in the market. We're still getting competitive growth. We would say competitive growth, but it's nice knowing we are reducing the volatility and reducing downside.
Yeah, because if and when the market swings, we're gonna protect more of the downside.
Right.
So
I think all that considered, I think again, just given the uncertainty from a geopolitical standpoint right now, it makes sense to have part of our portfolio, part of our strategy, again, depending on how aggressive or conservative we want to be in that allocation. So let's change gears just a bit, and I wanted to talk about again, the quality aspect of companies that we're invested in, and just a couple of things that I want to highlight. I mean, those are the types of companies that we're prioritizing, I would say, within that quality tilt is what we consider capital strength as a priority. So we want to look at companies that have good, strong balance sheets. I know you and I have talked about that before. Not a lot of debt, good, strong cash flow. Cybersecurity also is a portion that makes up that quality tilt, and also companies that pay dividends. So just cash flow focused companies.
I always joke about this, and I can joke about this now that I have a 17-year-old daughter. Quality companies are like the guys I want my daughter to date in the future. They've got a job, they've got a good background, not a lot of issues hiding behind
there. You go. Not a lot of baggage.
Yeah, not a lot of credit, not a lot of debt. But you're just nice guys.
Yeah.
And I think when we're talking about companies, if we think about companies like that, companies we would be happy to take home to mom and dad.
There you go.
So
I love that. That's good. But I think, again, the point that is important to make with that is those companies, through those companies, we have that exposure to the defense manufacturing, aerospace equipment, that diversified kind of aerospace and defense manufacturing, which, again, given the potential and the uncertainty for geopolitics to continue to be an issue, that is something we wanted to make sure we had, some exposure to.
And I've got to imagine with the new budget that just got passed, with quite a bit of spending going towards Ukraine and Israel, and I know that's meant to refill our stockpiles as a country as well. Right. But I've got to imagine that will impact some of those aerospace areas.
I think so.
Defense spending and whatnot.
I do think so. That's the idea. But just so as we kind of wrap up this part of the discussion. I know I'm going to end. I think we've got one final slide that I did want to end on, but really, from a portfolio standpoint, our goal is really to just make sure in this environment right now that we're building, portfolios that are good, balanced, really well diversified is really the best way that I can say it. We've been in a market that has been very concentrated in a few companies. And you've heard us talk a lot about that, lately, or at least this year. And so really our goal in some of the adjustments we've made over the last 3 to 6 months has been to move away from some of the companies that have really high valuations or really expensive and have really been driving the market. Not completely, because those are still good companies, but just in our best efforts to create a good diversified portfolio. And then again, that slide I think really points to just the consistency of over time, the markets, we have wars, we have geopolitical tensions, all those things that occur. But if we look at performance over those periods of time, they still actually haven't been horrible. They've been pretty good.
Oh. All right. Well, thank you.
Thank you.
That's a lot of stuff. I'm just happy. Well, it's funny. I'm happy that we're not talking about the Fed, but with that said, we always like to have a segment of the show called Hey Hobart, and the question that we had selected this time was actually around the Fed, but I am going to pivot, and that's one of my new favorite words is pivot. I'm going to pivot because we've been getting a lot of questions just today, specifically around some talk that's come out of D.C. around the tax code. And again, I want to make sure that we're trying not to be too political. Everyone's got their views and beliefs. I've got my views and beliefs. I want to talk as much factual as I can with this. Real quick, before we go into the tax talk, if you've got a specific question, hello@hobartwealth.com is how you get a hold of us. Happy to answer your questions live. For the person that asked the question about the Fed, tune into so many other episodes because we've got so much Fed talk.
Well, they're meeting tomorrow, so we may talk
exactly.
about it.
So we'll have more info that way. But the question that we're going to throw out there is, there was yesterday some very significant talk from the current administration surrounding tax law changes, increasing the highest tax rate to 40%, having a massive increase on capital gains, introducing a capital gains on non-realized gains. So that means that when you don't sell something, you have a stock that you've made money in, but you haven't sold it.
That's come up before, I believe.
We've come up before.
We've seen that kind of surface.
And the other thing was, it was made very clear, although the White House did backtrack it a bit, where the president had said, "Hey, the Trump tax code, which we've talked about for a long time, is going away next year, and if you reelect me, it's dead for everybody." White House said, "Whoa. It's dead for the higher end earners, but the lower end people, there is actually some good stuff in there." And the reality is, a lot of our clients are, they're not the mega gazillionaires. They're people that actually benefit from the tax code. We've told you time and time again, at the end of 2025, the tax code goes away. If Biden is reelected, he's made it very clear he wants to clear it out as much as possible. I think the main thing that I want folks to understand is, a lot of this is pre-election talk, and trying to create the conversation and also trying to talk to different bases. When we talk about something like taxing unrealized capital gains, there's a belief that is just unconstitutional, and if that tried to pass, there'd be massive fights. It's hard to tax people on something that they haven't realized yet. But again, if you're running for president, you want to throw that out there and you want to talk to your base that says, "Hey, tax the rich people." On the flip side, an increase of the tax rate to 40%, could definitely see that happening. Expiration of the Trump tax cuts from years and years and years ago, could definitely see that happen. So when we talk about that, as well as the increase in the capital gains rate, again, capital gains taxes tend to be favor wealthier folks. I will tell you though, part of the reason you work with us, or you may want to work with us, is because these are the things that we're into and we're researching every day. Just to give you an idea, a lot of times when they say, "Hey, we're going to increase that capital gains tax," what the ultra wealthy do is they say, "Fine, we're just not going to sell stuff. We're going to borrow against our assets that are highly appreciated, and therefore we won't create a taxable event." It's a solution.
Right.
All this to say, it's a wait and see scenario. A lot of bolster talking right now. It's going to be fun to watch in debates. I've heard that there's going to be a debate this time, so hey, I'm looking forward to it because I want to see the rumble. It'll be interesting. Anyhow, I hate to pivot on us, but I did think it's more important for us to talk about taxes today, and that's really the big part of our agenda today. If you've got any specific questions yourself about what we talked about today, or you're just wondering more about what we can do, or questions about your specific financial situation, we are always here to help. You can always call us. You can email us anytime with your questions about retirement income, investing, taxes, really anything related to your money. Most of all, I just want you to understand we appreciate you taking the time to join us today. For clients out there, thank you so much for putting your trust in us. And for folks that are just exploring, we'd be happy to talk with you however you'd like. All right, that's all for April. See you in May for the next Wealthologist Live. Have a great rest of your day.